The FHA just approved 40-year mortgage terms. Let's talk about the good, the bad, and the ugly. Stick around. So guys, welcome back to the platform. If you're new to the channel, make sure you like, comment, and subscribe, and leave the comment that says I subscribed. For everyone who leaves that comment, I'm going to send you instant access to my free real estate training. It's going to show you how to acquire properties for pennies on the dollar all across the country. You don't want to miss out on that free offer. But I wanted to get into this article with you guys on 40-year mortgages, an explanation of the pros and cons. Rocket Mortgage just dropped this. And this is important because the FHA recently, as of like a week ago from the making of this video, approved 40-year mortgage terms backed by like an FHA loan. So this is really important because it's the precursor for federally backed 40-year notes, which is one of my predictions if you've been following the channel from about 6 months ago. There are even 50-year mortgage terms in other countries, right? So this stuff will inevitably hit the US as well. So let's get into this stuff, guys. The first question I get is, can you get a 40-year mortgage? Well, yes, some lenders do offer 40-year mortgages. But before we get into all of that, let's talk about who offers that. Well, there are lenders out there called non-QM, non-qualified mortgage lenders, non-QM. And you'll see a lot of these 40-year notes on bigger commercial deals. There are some that will offer this on smaller single family properties, rental properties, second homes, or they will offer it on like a 2 to 4 unit building. So those residential multifamily properties. But most of these historically we've seen on the larger 40, 50 unit buildings where the capital constraints are a little bit higher. This is a way where you can reduce that monthly payment, get more cash flow out of those bigger commercial deals as well. So you'll see this from a variety of different lenders. But yes, there are specialty lenders that will offer these 40-year mortgages. And what it is just a mortgage on a 40-year term instead of the traditional loan terms, which are anywhere from, this says 8, but usually we're seeing about 10, 15, 20, 25, and 30. That's like the standard. If you go to Bank of America, you're going to ask for a mortgage. They're going to offer you like a 10, a 15, a 20. Some of them will have a 25. I found the 25-year terms are more for commercial lenders. Like if you go to a credit union, they'll offer the 25s at very affordable rates. And then you'll see the 30-year fixed is like the slam dunk go-to, or at least has been in this lower interest rate environment that we've been in for the last 10, 15 years. And how do these things work? Well, they work just like your 30-year loan. The home loans can be fixed rate mortgages where your mortgage payment stays the same every month before accounting for property taxes, homeowner insurance, which homeowners insurance and property taxes can increase over time. So while you can lock in your mortgage on a 30 or a 40-year fixed or a 20-year fixed, the taxes can increase. You would want to budget in about a 1% increase for taxes on average for them to go up annually over the course of time. And your homeowner's insurance can jump. Like if you're in a place like Louisiana where there's hurricane season and there can be a lot of property damage from natural disasters, I've seen homeowners insurance premiums jump 60 to like 150% overnight, right? So these are things you have to plan for as an investor. These things can change. So you want a surplus of monthly cash flow coming in to cover a lot of these expenses. As we mentioned before, since these mortgage lenders that offer these 40 years aren't backed by traditional parties, 40-year mortgages may only be available from portfolio lenders. If you guys are in the 100 Keys Masterclass, my mentorship program, we talk a lot about portfolio lenders. These are the lenders that you go to when the bank starts to turn you down because your debt to income ratio is like horrendous, right? Once you get more than 3 or 4 properties, you just can't go to Bank of America. You can't go to Citibank. You can't go to the traditional banks because your debt to income ratio is out of whack now. It can't be federally backed. So once that happens, you are now dealing with non-QM lenders, and that would be a portfolio lender. And I've had portfolio lenders where I've done like 100 deals with them, 100 deals in a year, and they just keep writing those loans. So portfolio lending is when a lender holds onto the loan until it's paid off instead of selling it to an investor. So there are a lot of portfolio lenders out there. If you guys are in the 100 Keys Masterclass, or you just have questions about portfolio lenders. Reach out to me. You guys know how to get a hold of me. Click the link in the description, book a call. Let's talk one-on-one about how you can get tapped into some of these systems to accelerate yourself as a real estate investor. How do 30-year mortgages stack up against the 40? This is important. So the term of a 40-year mortgage is clearly 10 years longer. So that's kind of obvious, right, guys? But what happens is, because the payment is longer, it's extended and stretched out, your mortgage payment should be a little bit cheaper, right? Because the balance is spread over a longer time. Each monthly payment will be lower than it would be on a 30-year term. But what that also means on the flip side is you'll pay more in interest. We'll show you the math in a minute, but the 40-year mortgage will cost you more over the lifespan of the 30-year mortgage, right? Paying more interest over the long term is not ideal, but as an investor, if you're taking this property and maybe doing an FHA house hack, putting it on a 40, putting tenants in place in a multi and just cash flowing it, the tenants are actually paying down the mortgage, not you. So even though there's more mortgage interest, that's more tax write-offs, more mortgage interest deductions, the tenants are paying it, not you. So it's not necessarily a bad thing unless this is a single family that you intend to live in and that mortgage interest is essentially just coming out of your pocket. So let's look at the math. Let's assume a $225,000 loan on a house with a $250,000 purchase price. So you're putting some money down in equity into this deal. And there's a 4% interest rate, which we're not there right now, right, guys? But we're hoping to get back there as long-term buy and hold investors. And certainly the Fed is pushing inflation back and working us back down there. So on a 30-year term, the monthly payment is $1,074.18 per month. And the total interest to be paid over the lifespan of the loan is $162,000, we'll call it. So for this loan of $225,000, you're going to pay back that principal and then another $162,000 over the lifespan. If we go to the 40-year note, conversely, the monthly payment is cut by about $134 per month. So $940.36 per month is the payment. That's about let's call it $35 a month. That's over $1,000 a year in savings. So more cash flow in your pocket. But for that, you're paying $226,000 in interest on the total lifespan of this loan versus $162,000. So that's like another $60,000 in interest. So we'll do some top line math. Over the course of 40 years, you're collecting an extra $1,000 a year in cash flow. So that's an extra $40,000 in your pocket in cash flow. You're paying an extra $60,000 in mortgage interest for that $40,000 of cash flow. If you take that cash flow and reinvest it, I bet you could outpace that additional mortgage interest. And it definitely doesn't matter, right, if the tenants are in there paying the mortgage and covering that and providing you with cash flow. So there's definitely a benefit here, even though it's a con, and it's being presented as a con in this article. I think it's a con if you're going to live in these properties as a single family, but we're investors, right? We're here for the cash flow. So if you're cash flow investing, this is a major hack that you guys can use to get more cash flow out of these deals and make more profits, have more money to invest in more deals, and make even more money, break free from the 9-to-5. This is another tool on your tool belt that you guys can use to build more cash flow. If you enjoyed the content, make sure you like, comment, and subscribe to the channel, and leave the comment that says I subscribe so I can send you instant access to my free real estate training. It'll show you how to acquire properties for pennies on the dollar all across the country. If you want to learn more about my real estate mentorship program, you know how to get a hold of me. Click on the link in the description. You can tap into more free trainings that we have behind the scenes for you guys. Book a call with me one-on-one. Learn about my mentorship program, my boots on the ground program, how we build houses for people. Scroll through the YouTube channel and watch some of the testimonials from people who are getting results right now. And I'll see you guys on the other side. Brian Grimes, your real estate mentor, signing off.